This is Enrich Your Life, a podcast about financial health, all things investing, life planning, and smart decisions with Richard Limegruber.
Hello and welcome to another episode of Enrich Your Life podcast. I'm your host, Rich Limegruber, and I have 27 years plus of experience helping clients as a comprehensive financial advisor, helping them plan for their future, taking a look at their assets, their income. Today, we're going to be discussing one of the fastest growing investment industries, which is private equity. Private equity, and more specifically, the secondary markets. My guest today is Ian Forman, Director of Investor Relations at Ardian. Ardian manages or advises an estimated $200 billion of assets in private equity-related assets and creates liquidity within private markets. With 22 offices globally and over 350 investment professionals worldwide, they provide investment and customized solutions that reflect new economic dynamics in an ever-changing world. With over 17 years of industry experience, Ian joined Ardian over 3 years ago, coming from Barron Capital Group, and prior to that, JP Morgan. Welcome to the podcast, Ian, and thanks for joining us today.
Yes, excited to be here.
Yeah, this is going to be fun. We're going to be talking about something that in the past used to be reserved for some higher net worth individuals, and I guess through time, these types of investments like private equity have become more commonplace and more available to everyday investors like myself and maybe some of my clients that I work with, right? I spent decades helping people prepare financially for retirement, savings, and investing, and growing their assets. What very few people know is private equity has become more mainstream, offering more investors the opportunity to invest within private equity, where in the past investment opportunity was reserved really for the ultra high net worth clients. What made you decide to work with private equity and Ardian?
So I've been in the industry, as you mentioned, for quite some time now. And Ardian, many people don't know who we are, but they have heard of the company AXA, the insurance conglomerate. So Ardian actually was called AXA Private Equity for quite some time. And then in 2013, we spun off to become Ardian. Great. And the firm has historically raised capital through institutions. And then in 2020, we took a view that, and we saw this massive opportunity within high net worth individuals to raise capital through that channel and really build products that would be more accessible for everyday individual.
By institutions, you mean by like pension funds and major family offices and not so much the individual investor.
Exactly.
Right,
So in 2020, we saw the market opportunity there. So first we started our team in Paris, where we're headquartered. And then in 2022, we started the business in the US. So I joined the firm actually in 2023. And it's been incredible growth. And it's really exciting to be at the forefront of this private market democratization, as we call it, getting high net worth individuals exposure to private markets. And what brought me here today is my role is just really building relationships with folks like yourself within the private wealth industry. So banks, wirehouses, independent broker dealers, sure. And really educating the industry on private markets.
Great, yeah. And what a better opportunity than Enrich Your Life podcast to provide that education, right? So I wanted to start off with just the basics, right? So
sure.
For some people, they have no idea what private equity is. So in your own words, can you explain to somebody who's never heard it what private equity is?
Yeah, I'll bring it to life with an example.
Okay.
So say your neighbor owns a bakery.
Okay.
Everyone loves a good bakery, right?
Good bakery. Is it Italian or is it German? What kind of bakery is it?
Whatever your preference is.
Whatever your preference is, okay.
So say your neighbor owns a bakery. They're looking to expand. Yeah. And maybe they want to open another location. Maybe they are looking to upgrade their equipment, use technology to help really scale their business, and they don't want to take out a loan. They could look to a private equity firm to help with that growth. So what a private equity firm will do is offer them capital, and in exchange, they will take a percentage of that business. So
they're coming in with a cash infusion and investments
exactly
into the business.
Exactly. So the private equity firm, within the industry, we call them GPs or general partners. They won't put up all the capital themselves. They'll look to their investors, and within our world, we call them limited partners or LPs. So they will pool LP capital to invest in the bakery. And then years later, typically on average 4 to 7 years later, when that business has grown, they will look to exit that company. So either bringing the company public, merging with another company, or even just selling to another private equity firm to really gain to gain capital for their investors.
Right, and hopefully make money for everybody, right?
Exactly.
I mean, the prime example that I always think about when I think about private equity is you have a company who's limited based upon the amount of cash flow they have, right? So they can't really take any more money out and invest it. So they're looking for somebody to come along. Although they might have to now share moving forward, I always say I would rather get 50% of something than 100% of nothing, right?
Yes.
So if you can provide that extra capital, you can grow and expand, and you're going to have to share that now, but you're still making a lot more than you were prior to getting that capital injection, right? So private equity is often categorized as an alternative investment. Many people who hear the word alternative assume it behaves differently than stocks, right? And obviously that may or may not be the case. So is private equity expected to move opposite of public markets, or is the relationship more nuanced?
Yes, so there is some correlation to public markets, but there are key differences between the two.
Okay.
And I like to use an acronym. I call it VALT, VALT. It's value, access, liquidity, and transparency. So in terms of value, for just your regular stocks, right? You could actually see the value on a minute by minute basis, right? Yep. So you are seeing the value of your investment at any point. Where in private markets, or specifically private equity, typically the GPs will they will price their companies on a quarterly basis. So as an investor, you typically don't see those marks until a quarterly basis.
So when you look at the equity markets, the public markets, and the stock price is going up and down throughout the day, your private equity is not really moving an NAV price up or down. It's steady.
Yes, exactly.
And it's just once every 3 months on a quarterly basis.
Yes, exactly. Well, depending on the product that you're in.
Sure.
And then access. So to access public markets, anyone could do it, right? You open a Schwab E-Trade account and you just buy a stock. For private markets, typically to get access, you'll need a financial advisor like yourself, Rich. And typically there are some thresholds where you need a certain amount of wealth, or you need to make a certain amount of money to qualify for these products.
Correct.
Liquidity. So liquidity, you could...
Your ability to change it from the investment into cash.
Yes.
Right?
Yes. So for liquidity in an everyday stock, you just go online, you submit a sell order, and then you could have your cash back. Right. For private markets, typically to get liquidity, there's a longer lockup period, right? So that's a big difference. And then transparency would be the last one, where if you're publicly listed companies, they're required to show their
books,
all their books, all their financials to the general public. Your neighbor's bakery, they don't have to share that information, right? That's private information that doesn't have to be out in the public. So that's a key differentiator.
And I think that's where somebody like your financial advisor would do their due diligence on the multiple private market funds that are available, and make sure that who they're picking for their clients is somebody who has experience doing it, has back tested returns, and can show that, because really, I mean, you're depending upon those, general partners to really know what the heck they're doing, going in and kicking the tires and stuff. So that's where it's important to have a good company, a private equity company who knows what they're doing. So when people hear private equity, they often think of billionaires and large institutions, like you had said it was previous. Who actually invests in private equity today?
Yeah, so it's everyone, and you have the institutional investors, which I highlighted before. So that's public and private pensions, insurance companies, sovereign wealth funds, foundations, endowments, and then you have individuals and family offices as well. So really across the spectrum, everyone's investing in private equity. However, a really interesting stat is if you look at just all the wealth in the world, half of the money is with institutions, half of the money is with individuals. Huh? However, when you look at who owns private equity, 84% is owned by institutions and 16% is owned by individuals. Uh-huh. So it's really exciting to see that, with a lot of the new products coming to market within private markets, that there is this shift to your everyday individual being able to get access. So right now, most of the capital or the bulk of the money in the world is the private equity firms are held by institutions, but I think that shift is going to change.
Slowly but surely, right? Yeah. And I think it's because you guys are making it more accessible, but the industry's making it more accessible, right?
Exactly, it is.
So there's a couple of different structures that you could look at. One I know is called the interval structure, and I think that's the one that we're talking about today, right?
Or evergreen. I would call it evergreen.
I'm sorry. And then the other one is evergreen, right? So the interval fund is the one that you could buy with a ticker symbol, and at your local brokerage, and it has quarterly liquidity. But the evergreen structure is one where it's actually a subscription agreement through your financial advisor, and you still have quarterly liquidity, but there is a subscription because there's further underwriting that gets done for the client who's looking to purchase.
Yep.
And that underwriting is done not only by your financial advisor, but also by you guys to make sure that they have the ability and liquidity elsewhere, so that they're not dependent upon the investments, right? And I think that's one of the biggest things about private equity people misunderstand is like, oh, I can never get my money out. And of course, that's not true. They'd rather you keep it in so that the investment continues to grow and you don't have liquidations and have to sell things when the markets are down, right?
Yeah.
At the wrong time. So they do provide liquidity. It's just limited. And that's why you guys do your own research and make sure that the client has the ability to actually purchase this and not have to sell it within 3 months, 6 months, and so forth. Right?
Correct, yeah. And it really should be looked at as more of a long-term investment.
Yes.
Because that's, if you as a individual have kind of your two buckets where you have liquid and illiquid, we think this really should be considered more of an illiquid asset class because of just the nature of how it operates.
Define long-term. What would you say long-term is?
I would say 10 plus years.
10 plus years.
So
that's what you should expect to keep the money in there. Although you don't necessarily have to. I always explain to my clients, when we're talking about investment time horizons, that can change. So you can invest something saying, I have 10 years for this money. And then 6 months from now, your goals might change and you might need to access it. So as much as it could be liquidated in a year, that's obviously not the best way to invest in these type of products. So right now, what type of companies are private equity firms typically investing in? Sure. I think it's for private equity, it's more about supply and demand. And if there's a demand, that's where you guys go, right?
Mm-hmm. Yeah, well, I would categorize private equity into 3 categories. So there's buyout, venture, and growth.
Okay.
So buyout, I would say, is the most classic. When you hear private equity, it's you're referring to buyout, and this is where a GP is taking a controlling stake in a business, and these companies are typically more mature, more stable cash flows. Yeah. Venture is more early stage. So that's like if you've seen Shark Tank, right? Most people have. Sure, it's a great show. I'm a big fan. So those are, entrepreneurs coming to gain capital from venture capitalists. Yeah. And that is more early stage, higher risk, but higher potential reward. Mm-hmm. And then in the middle of those 2 buckets is growth. So growth is, you're past the startup phase. The companies are growing fast, but you still need capital to get to that next phase. Okay. So I would categorize private equity into those 3 buckets.
Okay. And are there investment products that allow all 3 of those to be purchased at the same time with one, I guess, QSIP, or is it like each of them more sector related? Like you can only buy growth, or you can only buy venture, or you can only buy.
There's both. So there are more, I would say, sector-specific type funds that are only going to have access to some of those. But then there are also more broad, diversified funds as well.
Okay. And so when a private equity firm does come in and they take over, right, what's the value that you're creating for somebody who might own your private equity fund and you just came in? Is that something where somebody from Ardian or any other private equity firm actually injects themselves into the daily activities of a business and says, hey, you guys have been doing it this way, why wouldn't you do it this way? Or if you notice the marketing is not as good as it was, maybe hire a marketing team to come in that you guys know about who can turn things around. Like those are the types of opportunities that you're looking for, right? And I think that's great because there's a lot of great companies out there that, somebody who used to own a business 20-something years ago, I'm highly critical when I walk into the same business that I used to run, and I'm always like, they should do this instead, or I get it. Everybody has their own way of doing things, but there's a right way and there's a wrong way sometimes. And if you want to be a profitable company, there's right ways and then there's wrong ways. And if you can come in and identify that roadblock or that situation and correct it, and now all of a sudden you become even more profitable, right?
Yeah, absolutely.
So it's not simply buying low, selling high. It's more involved than that, right?
Yeah, we wish it was that easy.
Yeah,
but yeah, there's a lot that goes into it. It's sourcing the deals, doing due diligence, valuation, structuring the deal, financing the deal, negotiating the deal, and then once we're in the company, really rolling our sleeves up and doing the dirty work, and then prepping for sale and choosing the right exit route. So there is a lot that goes into it.
Great. Yeah. So comparing returns, right? Some clients are like, well, my S&P 500 fund has done extremely well over the last 2 years, Rich.
Yeah.
Why would I want to inject any kind of private equity into this at this time? So why should investors consider private equity over public markets?
Yeah, that comes up a lot. And just to give some numbers behind it. So right now there's about $16 trillion sitting in private markets.
16 trillion.
$16 trillion. And we've seen explosive growth in that area. A lot of capital keeps flooding into that space. We project by 2030 that number could be 25 trillion. And if you look at the number of companies globally that do over $100 million of revenue on an annual basis, 87% of those companies are private. 13% are public. So if you are not investing in private markets, you're not getting broad exposure to the overall economy, right? And half as many public companies today as there were 25 years ago. So there's half as many public companies as there were 25 years ago.
Companies that stay private for longer or are never going public.
Exactly. And the median age before going public has essentially doubled.
Wow.
So take, for example, SpaceX, right? That's been a very
hot
topic in the headlines. I mean, incredible IPO. It went public at $1.8 trillion. Elon Musk started SpaceX in 2002. Right, so it took
before
him
Tesla, wasn't it?
Yeah. So it took him over 20 years to go public. And why was he able to do that? It's because he had access to private market capital to continue to grow the business. So we're seeing more and more of that. And if you go back into the 1990s, companies would go public in 5-6 years. Today they're going public in more than double that.
Yeah. And the trade-off to that, obviously, public versus private is, why would investors look to lock up their money for a longer period of time? And I know what the answer is, but I would love for you to explain to my listeners why should somebody be willing to lock up their money for longer periods of time?
Yeah, it really comes down to performance. You're getting an access to a wider range of companies, right? As we just discussed.
Sure.
There's more companies that are private than there are public. You're getting more diversification. And GPs are able to identify companies that are mispriced more in private markets, because public markets, you have these all these big stocks. We'll use Apple as an example. There are so many analysts on Wall Street that are following these companies. All that information is public information. So theoretically, those companies are valued appropriately.
Yeah.
Where in private equity, you could find those mispriced assets and invest in them and really make some good returns.
And so what I would say, my answer to that question would have been a smoother ride. Not as many ups and downs. And that's one of the reasons why it's quarterly liquidity, right? So that the NAV stays a lot more steady. But also it gives somebody the ability to not have to be concerned if the markets are constantly going up and down. And just going back 24 months, the past 2 Aprils, we've seen the markets fall because of whether it was the announcement of tariffs or the announcements of the war with Iran. And I think ultimately private equities held up pretty well during that time because the consumers know this is probably temporary and has nothing to do with the stocks that are in these portfolios. And somebody doesn't necessarily need to call up and cash out, right? Where they could just go on their Schwab or whatever account and sell it and, be gone with it and make quick decisions. Whereas private equity is more stable, I would say, right?
Yes.
Yeah.
100%.
Cool. So understanding some of the trade-offs, every investment has risks. right? What are some of the biggest risks investors should understand before investing in private equity?
So one of those risks is what you just mentioned,
Yeah.
the illiquidity of the asset class.
Yeah.
Manager selection risks, so making sure you're picking the right manager.
Yes.
If you look at returns between the top quartile manager and the bottom quartile manager, there's a 10 to 15% dispersion between the two on an annualized basis. So you really have to make sure you're picking the right GPs to invest in. And then concentration and diversification risk. Some of the GPs that are investing in these privately held companies, they might only have 10 assets, 15 assets. So you want to make sure that, that's not your only exposure and you have more of a diversified bucket.
Right.
And then the last thing I would say is the risk is vintage year risk. So if you're allocating all your capital to one fund or maybe a few funds that launch in the same year, you're at risk of kind of that buying at a high valuation and those companies depreciating in value. So, for us, we like to see kind of more of a vintage year diversification. So you're getting access to different companies at different time periods.
Yeah. So don't throw it all at once. Dollar cost average into any investment, right?
Correct.
I mean, that's the proper way to do things if you're looking to, mitigate risk, which is great. So transitioning over to secondaries, which is what Ardian does very well.
Yeah.
You mentioned that there's several ways to access private equity. Can you explain the difference between primaries, co-investments, and secondaries, which are really the type of companies that you're looking to buy? I know you mentioned growth and venture capital in before, but these are a little different, right?
Yeah. So, so I'll explain the three categories. So primaries, and I'll use an example just to help bring it to life. So, we spoke about kind of the GP, LP, what the differences are there. So we'll use as a LP, we're here in New York, let's call it the state of New York, right? They have a pension fund, so the employees that work there, they have access to the pension, and the state of New York has to invest that money appropriately. And we'll use as a GP Blackstone, right? So the state of New York, they want to invest in Blackstone's latest fund. So typically their fund for institutional investors is a 10-year fund. The first 5 years of the fund is the investment period where Blackstone is going out. They're finding portfolio companies to invest in. As they buy those companies, they are calling capital from their LPs, such as the state of New York, right? After that investment period, years 5 through 10 is the harvesting period. So that's when Blackstone is selling out of these companies and distributions are coming back to their investors. That's a general primary fund.
Okay.
A co-investment is when, say, Blackstone does a deal and they have extra capacity and a LP that is one of theirs wants to invest alongside of them with no fees involved. They will allow their co-investors to invest alongside them on a single deal. So secondaries, that's really Ardian's bread and butter, right? And the way that works is the state of New York, they own Blackstone's fund, but they're over allocated or they need liquidity for some reason to their private equity positions. We will step in as the LP and buy their LP interests in their Blackstone fund at a discount in the secondary market.
Almost like a bid offer on a fixed income kind of a thing, right?
Yeah, so we become basically the LPs in the fund, and it alleviates kind of
gives
the
them the
state of New
liquidity
York.
they need. You come in and you have a company that you already know about that's already been vetted by Blackstone and by New York State. And it's kind of a really good example of quality investments that have been doing well. And now when you go into the state of New York and they're looking for liquidity, and obviously folks, this is all as an example. This doesn't happen, and if it does happen, it's all private stuff. But if, let's say New York State did need liquidity, right? You have the option to go in and look at their entire investment portfolio and pick what you want to buy from them?
Yeah, many times because it is really a buyer's market in secondaries, we have the opportunity to look at all of their private equity holdings and really pick and choose the funds that we want to buy. And we have a massive database to be able to do that.
That's where opportunity, right? So opportunistic, really.
Yeah.
Great. Okay. So now that we understand what private equity is and why investors may include it in their portfolios, let's talk about how Ardian manages the secondary markets. What is the appeal for the investor in the secondaries, and are you seeing anything that excites you right now?
Yeah. So I would say there's four key benefits to secondaries. The J curve, which I'll explain. Broad diversification, limited blind pool risk, and then cash back quicker than you would as a primary investor, right? So the J curve, right? So what a J curve essentially is in the first few years of a fund, capital is being called from their investors, and as an investor, many times you are not seeing any return yet because the returns are going to become later in the fund's life. So you will see kind of we call it the J curve, where your investment is actually losing value in the first few years. As a secondary buyer, because we're buying into these funds later in the fund's life, we're actually skipping the J curve and we're buying at a discount.
So for those who are trying to visualize the J curve, it's like a big hockey stick, right?
Yeah.
So if you look at the hockey stick and where the puck meets the stick on the ice is the beginning of it, it comes down a little bit and then it shoots all the way up.
Yes.
And what you're saying is you avoid that initial downturn and you're kind of buying it when it's all the way halfway up the stick.
Yeah, that's the goal. And then also, typically these types of transactions, we're already in places on the $1 billion plus transaction size, so we're doing really large deals.
Yeah.
And typically we're not buying one fund, we're buying multiple funds. So you're getting very broad diversification in the deals that we're doing. So it's not like you have that concentration risk.
Right.
You're very diversified when it comes to secondaries. And then blind pool risks. So this is really key because when you're an investor in a primary fund, you know the GP's track record, you know their investment process, but you don't know what's in the portfolio. For us, typically when we like to buy into these companies, they're already 70% to 80% invested, meaning we could look under the hood of these funds and know what we're getting ourselves into.
Yeah.
So because of that, it really reduces the risk that comes with investing in private markets because of when we're buying into these funds.
Great.
And then lastly, you're getting cash back quicker. So as I mentioned earlier, first 5 years are the investment period, second 5 years are the harvesting period. We like to buy in, right in that sweet spot between years 4 and 6, where we feel like we have transparency on the portfolio and we're actually starting to get distributions back from the investment. So you don't have to wait 5-6 years to see any distributions back. You're actually getting distributions immediately.
That's great.
Yeah.
So I'd like to switch off to the lightning round.
Okay.
Before we go, can you tell our listeners most important trait of a successful private equity owner?
Discipline.
Oh, I love that. Discipline. Yeah. Most exciting trend in private markets?
Yeah, the democratization of private markets, really being able to get access through these evergreen funds is really exciting. And we think that trend's going to just continue.
One piece of advice for investors exploring alternatives for the first time?
I would say work with a financial advisor like yourself and also think long term.
Well, is there anything else that you want to suggest or talk about before we let you go today? And
no, I think this was a great conversation. Thanks for having me on.
Yeah, it's fun.
Really exciting. Hopefully this was beneficial to your listeners.
Yeah.
And the secondaries market, it's unique, it's differentiated, but it's a really great way to access the private markets.
Yeah, I'm excited for it. I know most of my clients I speak with are excited about it. And ultimately, obviously, everybody should read the prospectus, take into consideration the risks, the liquidity issues, make sure it's within your risk tolerance, and work with a financial advisor. If you don't have one, there's so many people out there willing to work with you, with clients. And I know, again, I'd rather get, and this is me speaking as an advisor, but I'd rather get a large percentage of something than not 100% of nothing, right?
Yeah.
And that comes with, having a financial advisor who needs to get paid for his time, but that payment provides additional value that you might not have access to by going to one of the companies and just having a brokerage account and doing it yourself, kind of a thing, right?
Yep.
And we always talk about not only, the investment, but how it impacts everything else, right? So how it impacts cash flow, how it impacts taxes, which type of account should you open it up in, depending upon if it's spitting out a lot of income or not. So all those things, if you were somebody looking to invest in private equity, you would want to speak to your financial advisor about. Absolutely. So, well, thanks for tuning in to Enrich Your Life podcast. I'm your host, Rich Leingruber. Again, I want to say thank you to Ian and Ardian for, providing this great information to our listeners. I want to thank LMC Media and Vectorly for helping me produce this podcast. And we're always looking for new ideas, folks. So if you guys know of anything that you're kind of curious about and you want me to try to explain, please write to us at hello@enrichyourlifepodcast.com. And certainly we can consider having a topic that everybody's interested in hearing more about. Please remember to like, share, and subscribe to our podcasts. We're on all the major podcast sites. And you can go to my website, www.enrichlifepodcast.com. Thanks so much. Looking forward to seeing you soon.